Hello everyone, here we are with the final section or segment of this presentation of the notes from Global Asset Management Education Forum 4 in New York last week. We're in the second set of breakout sessions. In case you just jumped in here at part 6, here's how we got to this point. If you go to efficientminds.com, go over here to seminars, just hover above it. Down here, Game 4 conference notes, click on that. Soon I'll have these links active there, but this is the presentation. We will go to full screen mode. Let's get rid of this little banner. And we're in breakout session 2. Unfortunately, the hyperlink there won't work because it activates the page ahead. But we can just click here, breakout session 2. Okay, so the first session is the future of quant. In other words, the future of quantitative investing. The presenters, I pay attention to how many people are on the team and how much money they're managing. And this is a 20-person team managing $15 billion. It is reminiscent of the Yachtman team. Let's see if I have that here at the FAME conference last year. Make it big. Get rid of the banner. Yeah. So here on this gentleman's firm, they had only 9 people and they managed $13 billion of assets for over 100 clients. So firms like Oppenheimer, this group, small teams managing lots of money. Here we go again, small team managing lots of money. Pay extra close attention to them. All right, so HFT, or high frequency trading, is one of many types of quantitative investing. High frequency trading is highly competitive. The difference between high frequency, medium frequency, and low frequency trading is summarized in this table here. High frequency trading is based currently on price and volume data only, and its trades are executed on the microsecond, nanosecond level. Perhaps in the future, inputs will incorporate fundamentals, market information, Twitter feeds, all kinds of information, and the time horizon may get even shorter. When we're talking about all kinds of information, it reminds me of a entertaining fictional book to read called The Fear Index. It's where a high-frequency trading algorithm computer that has artificial intelligence gets carried away and starts to take over the world, kind of thing. So The Fear Index, I think it was Robert Harris was the author. You may want to check that out. All right, medium frequency trading. The inputs include fundamentals in addition to the price and volume, and those trades are on a daily basis. And then there's low frequency trading, which same data but weekly, monthly, quarterly, perhaps annually. So this is it's not to be taken as entirely distinct from fundamental investing, because we're looking at fundamentals here. But the decisions are driven by quantitative algorithm. Here's a couple articles to read on this. On the notion of using a formula instead of intuition, there is some evidence that, particularly in like medical fields, that simple formulas can outperform human intuition. So human intuition may look at all these fundamentals, look at balance sheets of multiple companies, but a simple formula with some scoring mechanisms running through a computer algorithm, running through a computer to do a simple computation may outperform the intuition of a human looking at a bunch of financial statements. But that's just something to keep in mind. Be on the lookout. I have an excerpt from a book on intuition versus formulas that I'd like to share at some point in the near future. All right. Oh, and by the way, every time you see something in blue and bold here, it's a link you can click and get the actual article. Most large cap stocks. Now, this first point is interesting. Most large cap stocks underperform the large cap universe. So if you look at the S&P 500, for instance, of those 500 companies, most of them will underperform the index as a whole, according to this statement, which means the performance of the large cap universe is driven largely by the largest companies. So a handful of good managers with concentrated portfolios could outperform the market. Again, since we have the Yakman presentation here, he also believes in concentrated portfolios. Now, keep in mind, this presentation in front of you now is from December 2013 in San Francisco. This one is from March of 2014. Other side of the country, totally different folks. Oppenheimer, quantitative investors, they also are advocate having concentrated portfolios. So I like the way Mr. Yakman why purchase your 50th best stock pick, right? The S&P 500 has 500 stocks. That doesn't mean all 500 are good performers or have good PE ratios. So why pick the worst ones? Why buy the worst ones? And that's the notion of having a concentrated position, as mentioned by Yakman last year, and as by these individuals from Oppenheimer last week. Again, I heard the question, what could go wrong? So these first two bullet points are suggesting diversification can be bad. I just kind of walked you through it. You're going to be buying, the 500 and 499, 498, the worst stocks based on some screen. Why would you put your money in those? Let's see. Low volatility stocks have negative correlation with low price to book. I'm not sure what that was. But what I haven't read is a very good point. The best way to generate alpha is to develop your own data set. Now, alpha is a measure of returns above that which is expected for the level of risk. Now, how to get higher alpha, according to these folks, is to use your own data set. You're not going to get it just looking at the same data on Yahoo Finance, but maybe some unique combination of the data that's available will help you generate alpha. And what they also mention is once you figure out an approach to assimilate different sources of data and form your own data set and generate alpha, once you do that, don't tell anybody. Just keep making money. All right, next up, financial services. Looks like I got a lot of slides on this. This was more of a segment to describe the financial service businesses from the perspective of Ernst & Young employees, and they were in different divisions of Ernst & Young. Let's see. There's a difference between financial services and asset management. Asset management is your standard financial advisor type role. Financial services, you could be creating financial products, such as credit default swaps, which didn't help anybody out too much there. I had an idea. How about a long, short rental, single-family products? Earlier in the conference, earlier in this presentation on my website, I mentioned that someone suggested a short home builders because the middle class just can't afford homes anymore. So why not short home builders and use that money to purchase stock in companies that own apartments? Just a thought. On a personal note, one of the presenters said Chicago's not as fast as New York, and doesn't give you as much. Didn't give that person the same kind of rush. Chicago. So if you want, pedal to the metal finance industry, you want to go to New York, not Chicago. The Ernst & Young, EY, their advisory business, with these new regulations, it's more billable hours, so they're doing well. There's structured finance. You structure financial products based on risk return, payoff profiles, and then sell it. Also includes asset valuation. If you're looking at audit versus structured finance, apparently audit you interact with more parties. And one of them said VBM guides. This is what I have here in red. In my MBA class, and I don't teach Finance 134 here, the follow-on to 101, but I'm pretty sure value-based management is taught at the undergrad level. I know it's taught in my MBA class here, so it was refreshing to see I'm teaching something that's actually being used by high-paid Ernst & Young consultants. Olive Garden and Radio Shack are hurting. I wonder if I should use them as examples. With value-based management, you look at areas of inefficiency based on financial statements and develop ways to improve, say, collection periods or interest expense, and then forecast the financial statements with those improvements to see how it impacts the current value. It'd be interesting to see if there's any way to save Olive Garden or Radio Shack. Okay, moving on. They spend a lot of time doing valuation and looking at what types of assets are out there. Once again, I mentioned here again, they talk about understanding the risk. What can you lose? It's another reason to consider the value at risk calculation. Now, I asked them during the presentation, do they actually go look at the properties that are underlying assets for these products? And for commercial real estate, yes. But when there's 10,000 single-family homes in a structured product, they don't have time to look at all those. So I guess they have to presume those homes exist or rely on the third party to verify the existence and structural integrity of those homes. Let's see. Let's see. Visa, $10 billion in goodwill on its balance sheet. For those accounting majors, goodwill is the amount in excess of the amount paid for a company. So let's say you have a company that has $100 in assets on its balance sheet, and it gets acquired for $132. Well, the $100 of assets will move on to the new company's balance sheet. The other $32 will move on to the new balance sheet as goodwill. I don't know what acquisition Visa has made. I don't know if there's another definition of goodwill, but I do know that 10 billion seems like a pretty large number of some intangible asset. And Ernst & Young, again, billable hours, they come up with values like that. The Basel, which is to help promote stability in the financial system, is going to increase some requirements on firms. Banks used to have complex assets, and they tried to count those as capital available to satisfy demands, but they had to unload it. And who bought them? Hedge funds, which I think is the right place for them. The mixing of banking, commercial banking, your savings accounts and whatnot, with investment banking, credit default swaps, I think was a mistake. Actually, I think I have a presentation on that on my website here. Let's see, Efficient Minds, seminars. Yeah, take a look at this financial crisis presentation, and you might see you'll see some information there on why I think it was a mistake to combine commercial banking functions with investment banking. Your mortgage and savings account, that should be stable and not mixed up with credit default swaps and these other complex assets that went to hedge funds. As far as your career goes and what credentials you need moving forward, well, it depends on what you want to do. At Ernst & Young and probably other big 5 or 4 firms, you need a CPA to do audit, and you won't make manager without it. So plan on getting a CPA. CFA, not needed, but it helps when interacting with hedge funds. As far as living in New York, if you can forget having a car, and a young lady from Alabama or Arkansas asked, what will it take for her to get transferred from Arkansas or Alabama to New York, and he told her, make sure you know that if you move to New York, you're choosing not to have a family, not to sleep, and to pay a lot to live there. So But nevertheless, wherever you're in, you got to put the time in, have a positive attitude. Networking is important. In that managers starting class, there were 120 people 7 years ago, and there's only 20 left today. So it's no family, no sleep, pay a lot. I mean, it's tough. It's tough in this financial business. I asked a question about what skill would you like to see new hires have, or that you wish you had at day one, and unanimously 4 people on the panel all said Excel skills. So make sure if you want to be in the finance business, accounting business, make sure you understand math, make sure you understand Excel. More on that, get good grades, get good with computers. Don't be afraid to ask questions. What I haven't read here is quote to the best I could what one of those Ernst & Young managers said. He says, when I need something done, I go to my Excel expert. He's accurate, capable, and gets things done fast. So I can't emphasize enough, know your math, know Excel deeply, not just adding a couple columns together. Become known for something. Acknowledge areas of weakness. A long time ago, when I was an undergrad, getting interview techniques, they suggested don't say you have weaknesses, say you have areas that need development. It's more of a positive spin, but in either case, make sure you take care of what needs to be taken care of. I hope you enjoyed this presentation, and thanks for listening. Thanks for watching. Make sure you click like or whatever it is in YouTube. I'm not up to speed on all that, and I will see you again for another presentation someday.